Good morning, I'm Angie Austin with Oil and Gas 360 here at the 2015 EnerCom Oil and Gas Conference. I'm being joined this morning by Randy Keys. He is the President and CFO with Evolution Petroleum. Good morning, Randy.
Thanks a lot. Good morning to you.
So we were talking about the turnout, quite a turnout here at the conference, and you've been here several years before?
Been here many times, and this is at least as big as last year, and very reassuring to see this many people here at the conference again.
I have to say, I've been impressed too with, the downturn and all. People are very positive, very upbeat, very excited to be here, very enthusiastic, but I guess you don't become a president of a company without being upbeat and positive and optimistic.
Particularly in this industry.
Correct.
But it's hard to be depressed in Denver. It's a beautiful location, and we're just managing through these difficult times in the industry right now.
Well, let's talk about the Delhi field first, Randy. The majority of Evolution's value is in the Delhi field in northeast Louisiana. Now, last November, the company reached reversion at Delhi. Can you talk about the production coming out of your Delhi asset and outline Evolution's financial interests in the asset?
Sure. We've got two interests in the field. We've got 7.4% in royalties and overriding interests that we acquired prior to the transaction with Denbury in 2006. And those bear no capital or operating expenses. In addition, in November of last year, we reverted into our working interest, which is 23.9% in the field, with a 19% net revenue interest. So that gives us a combined net revenue interest of 26.4%. Now, the field's currently doing about 6,300 barrels a day, and that's about 1,675 barrels a day net to us.
All right. Let's talk about development plans. Let's get into that area. Evolution is responsible for 23.9% of the CapEx at Delhi. So what's the projected spend at Delhi for the rest of 2015 and 2016? And then a twofold question, can you talk about the development plans for Delhi and how you will fund them?
Certainly. We've got the biggest part of our immediate capital needs is the NGL plant that we have currently underway. That's a $24 million project net to us, and we've currently incurred about $5 million of that. We've got $19 million left. Beyond that, there are some further development in the eastern half of the field. Those projects were underway last fall when the operator cut its budget. But we think those projects are going to come back in within the next 2 years. As to funding, we believe we'll be able to fund the NGL plant, our share, with working capital on hand and cash flow from the field. We do have a $5 million revolver as a backup. We don't expect to need it, but it is there in case we see further weakness in oil prices.
All right, let's talk a little bit more about that NGL project. The Ngl Recovery Plant seems like quite a nice project for you, obviously. So please tell us a little bit more about that project.
Well, we've been a proponent of this project for a long time. In fact, Evolution commissioned the first feasibility study on this plant as a non-operator back in 2012. Now, the purpose of the plant is twofold. As the field has matured, the methane and other lighter hydrocarbons have accumulated in the CO2 stream, and they have made the flood less efficient. They're currently at about 11% of the total CO2 recycle, and that makes it this is a significant impact on the efficiency because those hydrocarbons are less dense than the CO2. When the plant comes online next summer, we think we're going to get 2,000 barrels a day of incremental liquids production, plus about 500 barrels a day of gross crude oil production through increased efficiency in the field. And so we get both an operational necessity that we need the plant to improve the efficiency, and also we get a nice financial benefit, even in this down market.
Right, which is nice, as you put, nice financial benefit. Yeah. All right, so looking ahead, I understand Evolution has zero debt on the balance sheet. You've got $23 million in working capital and liquidity. The company pays shareholders a quarterly dividend of 5 cents per share or 20 cents per year. So what's next? What are your expectations for 2016?
Well, we're in a very fortunate position to have built-in growth over the next 5 years. We've got the NGL plant coming on next summer that should add significantly to our cash flow, and then beyond that, we've got the development of the eastern half of the field. So In addition to our 20-cent dividend, which is about a 4% yield for our shareholders, we're fairly comfortable with the path that we're on, and we really don't feel compelled to do anything differently going forward. However, we think that there will be some significant opportunities in the industry associated with this downturn, and that we may have some great opportunities. Our balance sheet positions us well to take advantage of these opportunities, and we think they could make a big difference in the long run for our company and our shareholders. So we're keeping a very close eye on developments in the industry and looking for potential new projects.
Excellent. Anything else you want to add?
Nope. Thanks for this interview. Thanks for EnerCom for sponsoring this conference.
It's a wonderful conference, isn't it?
Indeed.
Well, I'm glad you're enjoying it.
Thanks
I'm Angie Austin with Oil and Gas 360. Thanks for joining us for our interviews this morning here at EnerCom's 2015 Oil and Gas Conference. Thanks, Randy.
Thank you.